The cover story details how Europe needs to come together for the Eurozone to survive and business to thrive. Also inside this issue, though, is a story of how electronic trading is turning human beings into an extinct species, at least on the trading floors. This is a complex system, though, if computers can produce the kind of panic that we saw in the flash crash earlier this month. Paul Barrett is with us now. He is an assistant managing editor at the magazine, and he co-authored this story on the machines that ate the market. That's a great title. How long did it, was it very quick to come to you, that title?
Fortunately, there are brilliant headline writers. I was focusing on the text, and someone else came up with the clever headline.
All right, but one of the points that you make in this article, which is really interesting, is that 2 weeks later, still, no one really knows what happens.
Right. The SEC came out and said that they have 6 potential hypotheses as to what might have happened, some tentative proposals about new kinds of circuit breakers, but no one has addressed fundamentally how we prevent this kind of glitch in the future.
Now, well-known tech entrepreneur, investor, Dallas Mavericks basketball team owner Mark Cuban, actually, you have him quoted in your story. He tweeted after Thursday saying, "Wall Street is now a huge mathematical game of chess, and individual companies are just pawns." Do you think this is the perception that there really is no more human element in the markets? It's all algorithm-based?
Yeah, I think Cuban's point really is that we think of Wall Street, and Wall Street justifies itself as a way of allocating capital, bringing investors together with people who have ideas and who are forming companies. And his point is that actually the majority of Wall Street today doesn't do that at all. They're just trading at massive volumes at light speed, and really the companies and the allocation of capital has very little to do with what they're doing.
It's basically about math.
It's a combination of math and gambling and figuring out how to arbitrage one exchange versus another exchange.
So when we look at the problem, you mentioned the SEC's 6 possibilities for what went wrong. Do you feel like there's more people, more experts talking about regulation needing to be improved or infrastructure needing to be improved?
Well, I think both. I mean, the infrastructure has to talk to itself better. The exchanges at this point don't all have consistent rules. What happened on May 6th was that there was a slowdown in trading on the New York Stock Exchange, and that caused a lot of orders to cascade to other exchanges where there was imbalances created. So you need consistent rules, but you also need to wonder whether there needs to be some overall way of slowing the market down. Now, Wall Street will resist that, but there are people on Capitol Hill who, for example, have proposed a tiny transaction tax on every single sale of a security, and that would slow things down and possibly weed out some of the just trading purely for trading's sake.
Now, you mentioned something that speaks to liquidity.
Right.
What is the role of the high-frequency trader?
Right.
Because it's a misunderstood role, and many people say, look, high-frequency traders are good for the market. They add liquidity, but on Thursday, many people say they froze and they pulled out.
Right. Well, the whole justification for moving from a world where the New York Stock Exchange enjoyed basically monopoly status to the very, very dispersed world that we have today is that all of these traders trading at the high speeds that they are providing, there's always someone there to do a deal, basically. The problem is when you increase volume like that and you increase the speed of trading, and then at a given moment, because of some kind of panic, and there will always be panics, if people shut their computers off, then you can turn a down day into a crisis day. And so the question is how you kind of smooth that out.
Yeah, because I spoke with a few traders, and you have 1 or 2 quoted in your article as well, saying, hey, we saw what was going on, and we pulled out.
Right, and that's their right. The point is that they are not actually exchanges. They don't have any legal or other responsibilities to keep trading. And the question is whether they should have some of those responsibilities. That if they enjoy the status of being virtual exchanges themselves, do they have to have some responsibility, like the old-time specialists, of making a market even in very chaotic moments?
Paul Barrett, thank you very much. Paul Barrett joining us there from Bloomberg Businessweek.